pretty easy night, honestly. Big topics, but kind of the way this goes with this class, we don't really get into a lot of depth on the topics most of the time. So mile-wide, inch-deep is kind of the theme of all this content. So we begin with, can't talk tonight, can't get my throat cleared, sorry. So we begin with an idea that you guys have seen a million times, time value of money. So it's review, it's got to be review for everybody. You've done this in so many classes. So I just kind of on the notes, you know, they spend a lot of time going through this, so it's there for you. But yeah, I mean, this is just present value ideas. I think our best bet is to just look at example problems to kind of make sure we're clear on how all the time value stuff works, right? So I want to start with number 4, just because I want to make sure that you guys understand. It's a good thing to know how and why we do what we do with these tables. And this is kind of a good example to kind of explain that. So on number 4, it says we got a company investing in a machine with a 3-year useful life or a 3-year life or whatever. The machine's expected to reduce annual cash operating costs by $30,000 in each of the first 2 years and by $20,000 in year 3. All right, so we've got money being spent today, benefits coming in over periods of time beyond the year that we're currently in. So time value of money is a consideration, right? The fact that money today is worth more than money tomorrow, and you can invest something today and it'll grow to be a certain amount in the future. So when we're making decisions that will benefit multiple years, we want to kind of get everything on the same level playing field, everything in terms of today's money, right? And that's what we're building up to. We'll do capital budgeting at some point this semester, not yet, but we'll be using these present value ideas at that point. All right, so looking at this, real simple time value money question. We've got $30,000 a year from now at 14%. So this is our time, a little snippet of our time value table here. So 1 year at 14%, the table value, you know, y'all are familiar with the time value money tables, right? The table value is 0.88. So to get that in terms of today's money, we just multiply by the table factor, right? 30,000 times 88. $26,400. All right. Year 2, we'll have another $30,000. We'll look at the 2 years, 14% table factor, 1.65. Oh, wait. These are annuity factors. All right, yeah, never mind. Sorry, I thought that was single sum numbers. I remember this problem now. So they don't give us table values that we can really handily use. I'm just reading the problem here. This is why I wanted to do this one. So what if we don't have table factors? What can we do? We can handle this. All right, here's a little timeline of what's going on. We got today, a year from now, 2 years from now, 3 years from now. We got $30,000 happening a year from now. We got $30,000 happening 2 years from now. We got $20,000 happening 3 years from now. Those table values they give us are useless. Now you, on the CPA exam, would have access to these tables whenever you wanted them. And I think we all know how to use those things. But really, to get the present value of something, you can do it by hand. And this is a handy thing to know how to do sometimes. We shortcut problems sometimes. 30,000 in terms of today's money, 1 year at 14%. All you do is divide by 1.14, 1 in the interest rate. That's all you have to do. So $26,316, right? That's what that is in terms of today's money, right? We just did the table factor for that first year, right? 30,000 times 0.88. Now, they didn't round those decimals out very far, but we got 26,400 doing that. That's the way those table values are figured out, right? They took $1 and divided it by 1.14. What is $1 divided by 1.14? Oops. $0.87719. Right, 0.88. That's how those tables are built, right? They just take $1 and divide by 1 in the interest rate. For the second year, they would do it twice. For the third year, they would divide it 3 times. Now, these are annuity numbers, so that's not really working. But in year 2, we're just going to take $30,000 in the present value of it, 1 year, 2 years. That's how you discount that back 2 years at 14%. That's all you do. 23,084. 20,000 discounted back 3 years. Take that number. Back it out 1 year, 2 years, 3 years. 13,499. Add them up. That's the present value of all those future cash flows. So there's ways to easily do this by hand. Our number will be a little different from the answers because ours was more accurate. 62,899 is what we come up with. We're pretty close. 62,900. So that's how you do that. That's how those tables are built. So it's a good thing to know how to do. It's just a good idea to be aware of. You know, we learn all these present value tables and we just kind of blindly use them without really understanding them. That's how those tables are built. That's all there is to it. You know, the annuity tables are built using a lot more. There's a lot of complexities that go into that. But the present value of a single sum table, we could just build those right here, right now, doing exactly what we did. $1 divided by 1.14. There's our first year. $1 divided by 1.14 divided by 1.14. That's 2 years at 14%. We could build the whole table ourselves. So that's an easy way to do that. Just kind of a good thing to know. So bouncing back up to number 1. If you invest $5,000 in a CD that pays 3% per year, compounded annually, that matures in 36 months, 3 years, which is the following is the amount you receive. You could get the future value tables out and look at 3% column and 3-year row if you wanted to. Or you could save yourself the trouble of pulling all that mess out and you just say 5,000 times 1.03. There's 1 year. Times 1.03. There's 2 years. Times 1.03. There's 3 years. That's all you have to do. 54, 63, 64. So there you go. Good to know how to do that. Tables would have been fine if you wanted to do that. Future value of a dollar table right here. We're talking 3 years. We're talking 3%. There's a value of 1.0921273. 1.09273. So that big. 5464. You know how they get that table value? They said 1 times 1.03 times 1.03 times 1.03. That's how they got that table value. 0.092727. That's how they build those tables. So we're really doing that with the tables. But sometimes it's easier to just crank it out by hand. So, good things to do. Our number 2. Which of the following sets of interest or discount rates will give you a greater present value of $1 and a greater future value of $1? All right, so that requires you to think for a second, right? You can make up numbers, or not make up numbers, use their numbers and calculate it out, or you could just kind of think, future value. That's really easy to think about, right? The greater your interest rate is, the more your money will grow into the future, right? So obviously it's a greater future value if you're multiplying out by 10% each year. Right? So definitely a greater future value. All right, with present value, you're taking a future sum and dividing it by a number, right? Like we did. So you'll have a greater present value if you're backing out 8% or dividing by 8%, right? So, there you go. So the answer is C. That's a quick and easy way to think about it. I think the future value idea is more intuitive. You're investing money, larger interest rates going to give you more money, right? When you're thinking about getting the present value of something, you're usually applying the idea of a cost of capital instead of an interest rate that you're achieving, right? So the less the cost of capital is, 8%, the greater your value is right now. Another way to think about it. Number 3, which of the following changes would result in a higher or the highest present value? A $100 decrease in taxes each year for 4 years. A $100 decrease in a cash outflow each year for 3 years. A $100 increase in disposal value at the end of 4 years. or a $100 increase in cash inflows each year for 3 years. Which of the following changes would result in the highest present value? Well, this is really super easy. It's just kind of disguised as maybe a harder question, I guess. But this decrease happens 4 times, right? So there's no fancy calculations involved here. You want a 3-year deal or a 4-year deal? Like that $100 savings for 4 years, right? Here's a $100 savings each year for 3 years. Here's a $100 savings at the end of 4 years, only one time. Here's a $100 increase in what you're getting every year for 3 years. So this is super easy. Do it. We did 4. All right, number 5. Let's see. An individual received an inheritance from a grandparent's estate. The money can be invested, and the individual can either A, receive a $20,000 lump sum amount at the end of 10 years, or B, receive $1,400 at the end of each year for the next 10 years. 12% is our appropriate rate. Which one gives us the best value? All right. Well, I don't think I want to divide this by 1.12 10 times. So I'll probably go to the table for such a large number of periods. So option A, we got $20,000 at the end of 10 years. So one time, 10 years from now. So we're looking at the present value of $1. So in terms of today's money, given that interest rate that they gave us, that's worth $6,444. Now, yeah, we could have said 20,000 divided by 1.12 again, 10 times. That would have been a lot of number crunching. So the table's a lot easier for that one, right? All right. Option B is an amount every year for the next 10 years. Every year means it's an annuity, right? So we're getting $1,400 every year. Oops. End of every year. So we would look at the annuity table. $7,910. That's what that's worth. So the value of this one is bigger. They asked for net present value. There was nothing, net present value, which we'll get to in capital budgeting, but net present value is present value of future cash flows minus the original investment. There's nothing invested in this, so it's the cash flow minus 0, right? So that's our net present value. They were just giving us this, so we didn't invest anything. All right, higher is better, so we might. I think that's all. Questions on any of these? Pretty straightforward, right? Nothing to it. Just good old basic concepts of present value and future value. Present value we'll use a lot. You have used a lot. Valuing bonds and things like that. A big chunk of our day today is about valuation, more conceptually speaking, but a lot of that is just projecting out future amounts and discounting them back to present value to figure out how much it's worth. Right? So we need to consider all these time value of money ideas. No questions then? Everybody good? All right. Okay, interest rate concepts. Good, useful stuff here. Everyday stuff, a lot of it. Not everyday stuff for some of it, though. So we know what interest is. We're paying for being able to use somebody else's money, right? They charge us interest. That is the cost of using money of somebody else's. We know what a fixed rate is. We know what a variable rate is. That's pretty basic stuff. Prime rate's a word that's thrown around a lot in the real world. We know what it is, but we might not could explain exactly what it is if somebody asks us what it is. Right? So, and I don't know if this is just a straight up definition, but it does explain what it is. It's the rate of interest that banks charge to their most credit-worthy borrowers. Can't imagine that being knowledge from a test question, though. Market interest rate, we know all about this from dealing with accounting for bonds in like intermediate 2. Bonds will have a stated rate and a market rate. What's the market rate? That's what the market has determined, the value, the return they wish to get on whatever this item is that's out there. And that interest rate can depend on so many different factors. Basically, risk is what it boils down to, right? So we're familiar with that idea. The nominal rate or the quoted rate, they gave us all this mess that it equals. I wouldn't memorize the formula for this, but just kind of understand in general, these are the things that make up a rate that's quoted. They're going to consider things like, first of all, starting with just a risk-free rate, and then going from there, adding an inflation premium, adding a default risk premium, adding a maturity premium, adding a liquidity premium, adding or subtracting any other adjustments. The idea here is a lot goes into whatever rate's being quoted to people, right? So yeah, a general understanding of that, I think, is what you need, and an understanding of what all those things are, especially, this risk-free rate. That's an important term for sure. So it's the interest rate that would occur if there are no risks and zero inflation. And what is important to take note of is we usually determine the risk-free rate based on whatever the rate is being quoted on a short-term United States Treasury security, assuming no inflation. That's the risk-free rate. That's how we approximate risk-free rate. Good to know. So if you see what they're charging on government securities like that, that is the risk-free rate. You consider the government to have very little risk that they'll default on the loan, right? So from here, the things to note for sure are what causes the rate to go up. And there's terms with all this that explains exactly what it is, right? So we got an inflation premium. In other words, inflation affects the rate, right? And very intuitively, the higher the expected inflation, the higher the rate. It all boils down to the riskier everything is, the more we're going to expect a return. We're not putting our neck out and expecting nothing in return for it, right? Default risk premium, so the greater the perceived risk of whoever we're lending to, the higher the rate. Makes sense, right? Maturity premium, the longer the time to maturity, the more time there is for something to go wrong, the higher the rate. Liquidity premium, the more illiquid, the higher the rate. It's all very intuitive, very intuitive. So it's kind of easy stuff. And then just some really just definitional type things here. A stated interest rate, again, draw back on your knowledge from all the stuff we did in intermediate 2 with bonds. What did that stated interest rate do, or coupon rate, or whatever we want to call it? It does nothing more than determines what we're writing a check for to the people who lent us money. It is our interest payments. So the face value of the bond times whatever that stated rate is means you're getting a check for this amount. The market rate may be different from the stated rate. So that's where bond selling for a discount comes into play, or a premium comes into play, so that they can achieve a return different from that stated rate. All right. We've got the real interest rate. It's one of those that's kind of hard to remember what they're talking about. So it's this quoted rate minus the inflation rate. And there's a little illustration here that I actually typed out after seeing one of the problems in the assessment. So if you have a savings account that pays 2%, that's the quoted rate, nominal rate, whatever you want to call it. But meanwhile, out in the world, inflation rate is 3%. And your real interest rate is negative 1%. You're not earning enough to keep up with inflation. You are losing money. Right? So that's the idea of real interest rate. It's kind of a fuzzy word, it doesn't click in my head what they're talking about when I hear what's the real interest rate. So that was tricky for me to remember. We know simple interest. There's no compounding. It's just principal times the interest rate. Interest is not being computed upon. Interest is being earned. It doesn't compound. Compound interest does. So you got to pay interest on the principal and interest on the interest. And interest can be compounded in these problems annually, semi-annually. That's usually it. In the real world, usually compounding happens daily. So that'd be a heck of a lot of calculations here. So we usually have compounding happening semi-annually or annually. Effective rate we've talked about already in here. It's the interest rate that's kind of implicit in whatever the terms of the arrangement are. It's the amount of money you have to pay divided by the amount of money you are borrowing, but really only the amount you're borrowing and free to actually use. So if there's like a compensating balance, you're not really able to use that money. So your effective interest rate would be the interest you're paying divided by really only what you're have available to use. There's a lot of things that will affect your effective interest. We've already done those. And then you got APR. That's just annualizing the interest rate. When there's a fraction of the year, you got a semi-annual rate, you'll multiply it by 2. Quarterly rate, you'll multiply it by 4. That's really all they're talking about there. There you go. Just a whole bunch of terms here. Nothing difficult. To me, the hardest thing here is just remembering what are they talking about with real interest rate. Can't always remember that off the top of my head. Problems are pretty straightforward. Number 2, and careful one to go over it. Number 2, which of the following describes a relationship shown by a yield curve? So this is really just a definition, a bit of an obscure definition. I think this term came up a few weeks ago in an earlier section, actually. The yield curve just shows what the interest rates are as the time to maturity changes. So it's just a graph of the interest rate as the length of time that you're borrowing for goes out. So B is what it is. The relationship between the time to maturity and the interest rate. I don't know how important that is. It's easy enough though. So one. Beta. Oh, not beta, beta company. I'm like, we haven't talked about beta yet. That's in a later section. Okay, this is a company called Beta. Has nothing to do with beta from the valuation sections we're doing later. All right, so this company has arranged to borrow $10,000 for 180 days, so half a year. Beta will repay the principal amount plus $600 in interest at the maturity of the note. Which of the following is the APR that they're paying on the loan? All right, so we've got a semi-annual situation here. We need to figure out the semi-annual interest rate and multiply it by 2. And that would be the annual interest rate. Real easy. So number 3, we are paying back $600 on $10,000. That's what we have to pay for borrowing that for 6 months. 6%. So if we want to annualize that number, multiply it by 2. In other words, if we borrowed that $10,000 for another 6 months, then we pay another $600. And at the end of the year, we would have paid $1,200, right? $1,200 on 10,000. 12%. Real easy concept. If this had been quarterly, then we would have multiplied by 4. If it had been monthly, we would have multiplied by 12. Easy concept there. And we just kind of went over this idea in the notes. I copied it over. This is that real interest rate idea, right? Savings account pays 2% interest. But you're losing 3% from inflation. Just the idea of what's reality here. Right. Number 5. This is an effective interest problem, similar to what we did in earlier sections. So effective interest, what are we paying divided by what do we have available to use from the borrowings here, right? So we borrowed $200,000, we borrowed $200,000 at an annual rate of 12%. All right, so we got to pay interest on all of that, even though we don't necessarily have all of that we can use, right? So you're charging us interest on all $200,000. $24,000 of interest. But we got to keep 20% of that on deposit at the bank. So we're not really borrowing $200,000 because we can't use all of it. I think it was showing the wrong answer on mine, but yeah, 15% is what it should be. So $24,000 being charged on 160. 15%. Thanks. Okay, number 6. That gives a bunch of different interest rate numbers. risk-free rate, inflation premium, default risk premium, liquidity premium, maturity risk premium. But then they just say, what's the market rate of interest on a 1-year treasury bill? So if you remember from your notes, and we didn't specifically say this, but I have it down. The market price of a U.S. Treasury bill would be the risk-free rate plus the inflation risk premium. Now, we don't usually have to consider the inflation idea here so much in the U.S., but yeah, that's what it would be. So back to our problem, it's going to be so 2% plus 1%. I don't know that this is that important. I think it might have been an easy test question for them to write, so they did.
I figured they could have a lot tougher questions
Maybe.
on this than they were.
Yeah, I mean, and you never know what you'll get, but I mean, that's the thing about BC. They do not get into a whole lot of depth on some of these things. And that kind of makes it tricky to study for it, because it's like, surely they need me to know more than this. But no, not always.
That's what throws me off about it.
Mhm.
Is I feel like I should know more.
Right. Yeah, it's a little, makes you a little uneasy sometimes with the little amount that they do cover. But it's pretty consistent among the big 3 different CPA prep courses. So I figure they're on to something. Study what they have and see how it goes. Which of the following factors would not be relevant in determining a risk premium on a security? Earnings per share has nothing to do really. That's a profitability measure, right? Weird question too, honestly, though. All right, so just really basic definitions, easy calculations on that one. Kind of nothing to it. Moving on. All right, so now we get into the idea of valuing things. So valuation, a term we hear a lot, and it is exactly what we think it is. It's assigning value to something. So the quality of whatever we're valuing depends on the quality of what we're using to value it. And GAAP, this is important stuff here. GAAP has levels 1, 2, and 3. Level 1 is the highest level of quality, 3 is the lowest, and this is real easy to kind of remember. Level 1 is the highest level. We're talking quoted prices, identical assets, active markets, things you can observe, things that are reliable. That's the best, right? So that's easy to remember. Level 3, the lowest, unobservable. That's easy to remember. So level 2 is the stuff in between, right? That's the easiest way to remember that. Level 2 is better than nothing, but not as good as everything that's listed in level 1, right? So with level 2, we're talking quoted prices for similar assets, not identical. So similar assets in an active market, or it could be an inactive market. Inactive market, it's just, not a whole lot of trading activity on whatever it is these days. And, other random things there. But level 2 is just kind of the in-between. So that's good, important stuff there. And then they just talk about a couple of approaches to valuing things, very surface stuff, not a whole lot of depth here. This whole chapter is called Introduction to Financial Valuation, so you don't expect to see much. So our approaches to valuing things, there's a market approach. It says exactly what it is. You're using things that are observable in the market, prices, whatever information you can gather involving market transactions, to value what you're trying to value. That's the best method if you have the information. You don't always have the information. Think about buying and selling houses. They'll always do comps. What did other houses in the neighborhood sell for? Well, that's a little fuzzy, right? Houses are very different. So, it gives you a little information, but not perfect information for sure. Income approach. This is what we did a lot of when I used to teach financial statement analysis and valuation. We would try to forecast future amounts, and we would have all these fancy formulas, and ultimately we'd end up converting those to present value numbers to see what all the things are worth that we expect, right? We did this thing called the residual operating income method, which was pretty intense but kind of fun. We did other methods too that involves forecasting and then present valuing it. And then cost approach, kind of off to the side type thing, trying to figure out how much it's going to cost to construct something. It could be useful in limited circumstances. Really, that market approach and income approach are the important things there. So there you go. There's no questions for us to look at in this. Keep moving. Actually, the next chapter really just kind of repeats the whole level 1, 2, and 3 stuff again. So I don't know, they like that. So we do have some questions we can look at. Number 1, which of the following levels of U.S. GAAP hierarchy of inputs used for determining fair value can be based on inputs not directly observable for the item being valued? Well, level 1, that's observable. That's what makes it level 1, right? So no on level 1, but yes on the other 2. Levels 2 and 3, you get into a little less ideal situations, so not directly observable. Sounds pretty easy. Keep my drink in front of the camera. These are actually really easy questions here. Number 2, assuming they are traded in an active market, which of the following types of investments could be valued using level 1 inputs? Either of them, right? It says they're traded in an active market. Why couldn't you? It's just kind of like, of course, right? Either. Not really much else to say about that other than I wouldn't be. Number 3, quoted prices in which of the following types of markets could be level 2 inputs for determining fair value? Active markets, yes. Inactive markets, yes. You're just kind of dumb. Now, if it said level 1, it would be yes for active, no for inactive, right? Which of the following types of active markets could be considered or as providing level 1 inputs? New York Stock Exchange, absolutely. Over-the-counter market doesn't sound on the surface like it would be, but over-the-counter market is just things like stocks, commodities, currencies, blah, blah, blah. They're traded directly between 2 parties without this central exchange or broker. There's no physical location. Trading's kind of done electronically, but it absolutely works fine for level 1 inputs. So there you go. Number 5, which of the following levels are likely to be most appropriate for valuing basic agricultural commodities. So think about it. This is standard things. There's definitely active markets for it. It's definitely observable. You know, identical in nature. Corn is corn, right? Widely traded, so level one for sure. So yeah, that's it. Nice and easy stuff, yes? I think so. CAPM, y'all seen it, I'm sure. We don't get that deep into it here. We're not really doing a whole lot. It's a simple formula. Well, I wouldn't call it a simple formula, but it's a formula. And understanding kind of what goes into it is definitely worthwhile. You might have to crunch a number on it, but really they like to know whether you know what beta is, kind of more than anything. So CAPM, capital asset pricing model. You're valuing securities and things like that, and it's all looking at risk, expected returns, and things like that. Time value of money is part of it because of the risk-free return that's in there. Risk is captured by beta. Beta is neat. So beta is just a kind of a big old regression number, regression model being run on historical, what did this stock do? What did the market do? And it just looks at how a stock over time follows the market, basically. It's just a regression statistical number. It's a measure of risk. The definition here is a measure of systematic risk. It's reflected by the volatility of an investment. So it measures, this is important, it measures the volatility of a stock in relation to the overall market. If the market goes up, historically speaking, what do we expect this stock to do? Is it going to go up more than the market? Is it going to go up less than the market? Is it going to kind of be right there with the market? It's just a measure of risk. The market's going to do something. How volatile is this particular stock? Changes in the market. So if it's a number greater than 1, it is more volatile. It moves greater than the market. So if the market goes up, this stock goes up, up, up. If the market goes down, this stock goes down, down, down. Right? It's volatile. There's risk. It's risky. Less than 1 moves less than the market. If the market goes down, it kind of goes down. Market goes up, it kind of makes its way up a little bit too. So it follows the market, just not as much. There is, theoretically speaking, such thing as negative beta, where if the market goes up, the stock goes down. And I've looked it up to see if there were any examples, and I don't know how true this was, but I like the idea. They said that hot dogs had negative beta. So market goes up, things are good, people aren't buying hot dogs.
That makes sense.
I guess so. I like the idea.
Yeah.
I don't know if it's true, but if the market goes down, times are hard, people are eating cheap junk, right?
Yeah.
So hot dogs are going up. It makes sense. I don't know if it's true, but it conceptually kind of explains the idea of negative beta. But most of the time, the stock moves with the market as in, overall. So higher the beta, higher the risk, lower the beta, lower the risk. And there you go. So the questions. What does beta measure in the capital asset pricing model? Volatility of a stock relative to its competitors? No. Volatility of stock relative to the overall market? That's exactly what it is. Unsystematic risk? No. Systematic risk. Very systematic idea, right? Number 2, Which of the following categories of risk does an investment's beta measure? We just said that. It is systematic. Assuming the following rates exist in the U.S., prime rate, federal discount rate, U.S. Treasury bond rate, inflation rate. Which of the following is most likely to be the nominal risk-free rate of return in the U.S.? We measure that based on what they're charging on these Treasury bonds. It's more of a question from an earlier section, right? So that is how that's our easy way of approximating the risk-free rate. What is being charged on Treasury bonds to the government. Number 4, all right, so this is one that requires us to know the formula. So we start with the risk-free rate. And we add a little premium to it. And that premium is going to be beta times the expected rate of return minus the risk-free rate. And then just plug the numbers in. So 2% plus 1.4, greater than 1, right? So we said if beta is greater than 1, it's riskier, it moves higher than the market or lower than the market, depending on which way it's going. Expected return 9%, risk-free 2%. Follow that out, it's 11.8%. This is just knowing the formula and filling in the numbers. Pretty basic, pretty easy. Big formula to kind of remember, but it's not that hard. Which of the following beta values indicates the least volatility? We are looking for the lowest number. 0.5 is the lowest number. Simple. If we're graphing a plot that shows beta points that are beta, we are looking at a relationship between what? We're looking at a relationship between the assets return and a benchmark return, which is the market, right? Our particular assets return compared with the market's return. So that's the benchmark return. Number 7, which of the following is not a limitation of the capital asset pricing model? So to get your mind right, all of these are limitations except for one. So we got 3 limitations and one that's not. We're looking for the one that's not. So A says it assumes there are no restrictions on borrowing at the risk-free rate of return. B said it assumes no external costs are associated with the investment. C says it fails to consider the time value of money. D says it fails to consider risk derived from other than variances from the asset, blah, blah, blah. Lots of words here. The easiest way to do this is to look for the obvious. That ain't true. Okay? It does consider the time value of money. That's the thing we know. Who cares about the other 3? We know we're good with that one, right? Because it incorporates the risk-free return as part of this formula. So we know that it doesn't fail to consider the time value. So that is not a limitation. It's a weirdly worded question to me. But the key takeaway here is not necessarily what A, B, and D are saying. Those aren't, oh, I need to know this. It's really the idea of, I need to understand this is the time value of money concept. All right. Questions on that section? Okay. Moving quick tonight. Okay. Option pricing. Okay. So concepts here, easy concepts. You'll get a feel for what they're looking for on this. So an option, I think we know what it is. It gives whoever owns an option has the ability to exercise it. They don't have to, but they have the ability to, depending on what type of option it is, they'll have the ability to buy a certain thing at a certain price, or they might have the ability to sell a certain thing at a certain price. So stock options come to mind, right? You have an option, they're telling you, hey, you have the option to buy this stock for $10 a share at any time during this period of time. We wouldn't want to do that unless the stock actually exceeded that price, right? We've got a deal. So an option may never end up having any value. It may end up having value. We are trying to price options in this chapter, or at least we're trying to understand the idea behind pricing options. We don't have to crunch any numbers here. It's way too complex for the CPA exam. So what we need to understand is, first of all, the two types of options. There's a call option. If we have a call option, we have the right to buy a stock. And that's kind of the example I just kind of put out there. So unless the value of the stock ends up going higher than the price that you are able to buy it for, it has no value, right? This goes up as the value of stock goes up. These are all concepts you kind of need to have a grasp on. They're not hard. A put option gives you the option to sell the stock at a certain price. So it has value if you can sell it for a price that's higher than what it's actually worth, right? So it increases in value as the stock price goes down. Stock's going down, but I'm like, hey, I get to sell this to you for $10, even though it's worth $8. I have an option, right? Easy concepts, important to know though. Okay, so that's just the basics. Now, here's some more information, and then it's going to kind of be repeated again here in a second, but this is kind of the meat of this chapter, is what different things happening, how do they affect the value of an option. So, time to expiration. The longer the time, the more it's worth, right? Think about it. You have an option for the next 10 years to sell the thing. A lot can happen in 10 years. You're going to like that, right? It's like, oh man, this thing has a chance to go up, up, up. At some point over the next 10 years, that's a long time to be watching this thing. That makes it more valuable, right? So that's good. Higher the risk-free rate is, the greater the option value. So this is just an idea of interest rates and things like that. Volatility, risk, riskier is actually going to lead to greater value, right? Volatility means it has a chance to go higher up or down as the market changes. So, riskier adds value. And that might be a little counterintuitive, but if you got an option to buy stock and this stock is super volatile, that can really work in your favor. It might go whoop, way up. You're like, yes, I'm going to strike now while it's up there, and I'm going to be great. You know? Dividend payments, smaller the dividend payment on the stock that you have an option on, the better, because they're retaining more earnings instead of paying them out to people who own the stock, right? You don't own the stock yet. You don't get the dividend. The less they have to pay out to these other random people, the better for you, right? That's pretty intuitive. But there's a model called the Black-Scholes model. It's beyond what we need to know for the CPA exam. But the assumptions underlying the model is where our test questions come from. And it's just the idea of kind of what we were just saying, which will lead to a higher value for the option. The higher the current price of the stock is, obviously, you're getting closer and closer to being able to strike, right? Higher the risk-free rate, we already said that. So the higher the interest rate. Longer the time till it expires, gives you more time for something good to happen. Higher risk gives you the chance for something crazy good to happen, right? And you know, risk means something crazy bad could happen too, but we're talking volatility. It may go way down. You just wait for it to go way up, right? And then they give you some limitations of the model. Maybe less important, but I listed it anyway. Obviously, stock prices behave randomly. That's a limitation of this model. We're not going to be that accurate, right? The inputs into the model, we kind of leave them constant over the life of the option. And rates can change, and volatility, you know, betas can change. We don't consider taxes in there. We can't really deal with dividends in there. And the options are only exercisable at maturity as part of the model. That's the way it's designed. So there's some limitations to it. But really, this is the good information for this. There's another, Black-Scholes, that's the classic there. But here's another one, the binomial option pricing model. Again, we don't have to calculate anything here. It's a variation on the one we just talked about. Here's the difference. I don't know how important this is, but it considers the security over a period of time instead of just one point in time. And it can be used to value stocks that pay dividends. So the output from this model, they say it's a tree diagram. You've got all these possible values at different points in time. So it's a variation on the other model that's got some nifty things to it. But the questions they ask, first of all, their text said calculating is beyond the scope of the CPA exam. And what do they do in number one? They ask us to value it. So I put it on here so I could highlight in red to say, don't do this. Don't worry about this. That's not important for us. The rest of them are more along the lines of what we're responsible for. Which of the following is not a limitation of the Black-Scholes model? So we saw those limitations, but these are easy. It's like look in there, look for the obvious thing. A says it fails to consider the probability that the option will be exercised. It doesn't fail to do that. But we really more know that these other three are limitations. It does assume the stock doesn't pay dividends. It does assume the risk-free rate is constant. It does assume the option is only expirated at the end, right? That's really the bigger takeaway from this is the knowing that we know the other three. Because I don't know what to answer A until I read B, C, and D on this one. 3, which of the following is not a factor routinely considered in valuing a stock option? Time until expiration, we talked about that and how it affects the price. Longer the time, bigger the price. Risk-free rate of return, higher the risk-free rate, more valuable the option. Exercise price of the option will certainly figure in. Industry classification in the stock. What the heck does that mean, right? So that's a kind of a throwaway once you get to D. 4. This is a good question here. I like the way they did this one. Which of the following options is most likely to have the greatest value? Leaving everything else other than those 3 things equal. So time to expiration. Longer the time, more valuable, right? So we got our eye on D here. Risk-free rate, higher the risk-free rate, the higher the value. He's still looking good. Beta measures risk, volatility. The more volatile, the better. Higher beta means more risk. So D is great all the way across. It's a really good question. I like that one. It's more the same. Valuing a business. So, people buy businesses. How do you assign a value to it? There's different approaches. There's a market approach, which we already talked about. You're determining the value by comparing it to other entities with similar characteristics in the same industry, in the same market, of the same size, with similar product lines and similar risks. And easy to find, is it? That would be theoretically a market approach. Income approach, here you're forecasting future income numbers. Some models prefer to forecast future cash flows, that kind of thing. There's different ways to do it, but then you present value it down to today to see what the value is. And then there's an asset approach, which would be appropriate if you're about to liquidate this thing, because there is no future income or anything like that. You're just selling off what's there. So you determine the value of the entity by valuing all the assets. What's the fair value of all the assets added up? That's the value, right? But backing up to the top again. So they make the point, obviously we're valuing a business or a portion of the business, but then they make the point that if there's an entity that's publicly traded in an active market, the market determines its value, right? That's kind of what the market does. So we can determine by the market cap. We supposedly have efficient markets that consider all the available information, right? So market cap would be the direct measure of its fair value. So they make the point that our prime concern for business valuation is valuing non-public entities where there is no market capitalization. What we mean by market capitalization is total number of outstanding shares times the market price of those shares. That's market capitalization. All right. So that's kind of neat. And then a few odds and ends here at the end. Things we've done before. Common size income statement, common size balance sheet. Texts, we'll call this vertical analysis, where you're expressing all the items. So like on your balance sheet, you've got your total. The biggest number on there is your total assets, right? So a common size balance sheet is going to show everything as a percentage of assets. That's what it would be. So cash will be like 20% or whatever, 20% of your total assets. So everything on there is expressed as that percent. It's really good for kind of analyzing things, big picture, and seeing things. Same on the income statement. Everything's expressed as a ratio of the biggest number on the income statement, revenue, total revenue, right? So it's just a handy tool to allow things to kind of jump out at you. Not real sure why they stuck that in this section. But it's an easy enough concept. Price earnings ratio, I think we may have not talked about this yet. So there's another we may have. I don't think we have. It's a good thing to know. Price earnings ratio is the market price per share of a stock divided by the earnings per share on that stock. And then free cash flow is cash flows from the operating activities on your cash flow statement minus capital expenditures. So that's just another number that some people find important. It finds its way into different ratios. The idea behind free cash flow is a company, cash flows from operating activities is obviously super important, right? It's what our operations is generating for us. So that's obviously the most important number on your cash flow statement. But free cash flow carries it a little step farther and says these companies are going to need to keep spending on capital expenditures to keep the business going as it should, right? These are necessary, vital expenditures for a company that wants to maintain, right? Necessary expenditures. So free cash flow is everything left over after those necessary capital expenditures. So they find that to be an important number for kind of gauging the health of a company. Price earnings ratio is an important ratio for gauging the health of a company. Common size financial statements is just a good tool for us to kind of give us a way to analyze things a little bit. All right, so just a few odds and ends here, really. So on the problems, they say if we want a common size balance sheet here, what would be shown for current liabilities? Everything here is going to be as a ratio to total assets, right? Current assets is going to be 50%. Investments is going to be 12.5%. Fixed assets is going to be 37.5%. Everything is just shown as a ratio to total assets. Okay. Same on the liability and equity side. 15%. 37.5%. 12.5%. 35%. This gives you a way to kind of see what makes up your assets, and it's especially helpful to have this for several years so you can see the receivables is going higher and higher as a percent of their total assets each year. That's not good, right? Their inventory is getting to be higher and higher percentage of their assets each year. That's not good, right? It just kind of gives us an easy way to look at those things. Ultimately, as a company, we want to be able to do more and more with less and less. So we really like to keep our assets down, right? We don't want idle cash sitting around. We don't want uncollectible receivables sitting around. We don't want tons of inventory sitting around that we have to store, that can ruin, that can be stolen, that can become obsolete, right? As far as fixed assets go, the more we can do with less and less, the better, right? I mean, obviously, there's necessary things we need, but ultimately, when it comes down to it, we want to do more and more with less and less. That's a good thing, right? All right, so anyway, to answer their question, current liabilities would show 15%. Number 2, which of the following approaches to valuing a business would most likely be appropriate when the business has been losing money and is going to be sold in a distressed sale? There's no income approach necessary because we're not going to be able to forecast any future income. They're done, right? They're losing money. There's no market approach here. This is where we're doing the asset approach. It's being liquidated. All this company is worth is the assets it has that they can sell off. There's no future benefit to this company. Price earnings ratio. I feel like they just kind of came out of nowhere with this, and that's why I added it to the notes. But it's important for sure. Market price per share of stock divided by earnings per share of the stock. It just gives you an idea of how the market perceives your company, right? You're earning this per share. The market thinks you're worth this per share. So the market's considering all kinds of things beyond earnings. They're considering what's the potential for your company in the future and all this. So higher price earnings ratio, better. It's a good idea of how the market perceives you. 4, land and building that constitute a strip shopping mall were valued using the recent sales price of a comparable strip shopping mall located across the street. This method of valuation would be an example of the market approach. They are valuing it based on things they observed in the market. Number 5, which of the following is not a major approach? There is no cost approach for valuing businesses. We mentioned the cost approach in that earlier section. And that's this real obscure off to the side thing where we're trying to figure out what the value of an asset is by trying to figure out how much it would cost us to construct a substitute item or acquire a substitute item. So it's appropriate for very specialized types of assets. And there is no way to do market approaches or things like that. But down here, with this one, we're talking about valuing a business. So that wouldn't make sense. There's no cost approach to valuing a business. Number 6, assume the following abbreviated income statement. All right, if we're common sizing this thing, what would we show for finance expense? All right, so again, everything's as a ratio to the biggest number on there. Total assets on the balance sheet, total revenues on the income statement. All right. So if we're common sizing this thing, it's easy percentages, isn't it? Cost of goods sold would be 60%. Operating expenses would be 20%. % finance expense. So what are they asking us? Finance expense. So D. So that's also good, especially if you have several years worth of income statements. You know, cost of goods sold, you expect that to stay fairly consistent over the years, right? It should be a pretty constant percentage here. If it's going off in some direction, then it'll be a problem. Okay, that's it.